Okay, so in this class, we're going to go over the fundamental tax concepts that are applicable to the taxation of securities transactions. So let me share my screen and we'll start by going over the PowerPoint. And then as we get into some of the concepts that are more transactional oriented, I'll pull up the whiteboard and we'll go over some examples. Okay, so when we talk about the taxation of securities, what we first have to determine is who is doing the transaction. What is the nature of the person doing the transaction? And there are basically four major participants in the financial markets. And I've labeled them with names, but they're, it's Irving the investor, Terry the trader, Harry the hedger, Debbie the dealer. So it's really investors, traders, hedgers, and dealers. And the same transactions will be given different tax results depending on the nature of the person doing the transaction. Now, for 99% of the course, the concepts that we're going to talk about and all the tax rules that we're going to talk about deal with investors. So today I'll go over some of the rules that apply to traders, hedgers, and dealers. And then I'll come back to the rules and go into a little more detail. But from that point forward and for the remainder of the course, we're really going to be talking about the tax rules applicable to investors. So for those of you who have clients who are hedge funds, depending on the elections that your hedge funds make, the material in this course may or may not be relevant to those funds. If those funds, and again, we'll talk about it in more detail, but if those funds make a Section 475 election, which allows them to treat all the transactions as ordinary income transactions, and they recognize all their unrealized gains and losses at the end of every year, then we're not going to be dealing with those kinds of taxpayers in this course. We're going to be talking about the traders who do not make those elections and who in effect are treated as investors. All right, so let's start. So what are the rules with respect to investors? The big rule, the big thing that's of ultimate importance is that gains and losses are considered capital. And we'll go into it in more detail, but the holding period of the asset, the holding period of the security that is sold is going to determine the rate of tax. Currently, the rate of tax on long-term capital gains is 20%, and the gains on short-term capital gains are taxed at ordinary rates, which is 39%. So there's a very big difference between recognizing income as a long-term capital gain versus a short-term capital gain. So that's the good news for gains. And by the way, these are the rules for non-corporate taxpayers. These are the rules for individuals, basically, individuals and trusts. However, if you have losses, you can't deduct the losses against your ordinary income. You can only deduct losses to the extent that you have capital gains. And then if you just have capital losses and you don't have any capital gains, you can deduct $3,000 a year against your ordinary income. For purposes of this class, I want you to forget about the $3,000 rule. It's a de minimis amount. We're going to be dealing, when we do tax planning and we do with the clients that you're going to be dealing with, you're dealing with people who are making a lot of money, and the $3,000 is really an irrelevant amount. So you should know that it exists, but for purposes of this course, let's just forget about the $3,000. So for this course, losses are only deductible to the extent that you have capital gains. If you don't have capital gains, you can't deduct the loss. Now, the good news for individuals is that if they do have losses and they can't deduct them, then as a general rule, they cannot carry the losses back. And again, we'll talk about one exception to that rule later on in the semester. But losses, capital losses can't be carried back, but they can be carried forward indefinitely. So if you recognize losses this year and you don't recognize gains for the next 8 years, and then finally in year 9, you recognize some capital gains, those losses can still be used against them. So they carry forward forever. Now, if you're a corporation and you're an investor, you still have capital gains and losses. The bad news is that the capital gains are taxed at the same rate as ordinary income. There's no benefit to a corporation to have long-term capital gains. So long-term capital gains, short-term capital gains, they're all taxed as ordinary income. But they're still limited when they have losses. So losses are only deductible, again, to the extent of capital gains. And there is no $3,000 rule. So for a corporation has a capital loss, it's their loss. They can't deduct it. And what's really bad for a corporation is, yes, they can be carried back for 3 years, which is nice, so that if I have a loss this year, and if I had a capital gain in any of the 3 prior years, I could carry back my loss to those 3 years. But then I can only carry them forward for 5 years. And after 5 years, the losses go away forever. So if I have a $10 million loss and I incur it this year, 2021, and then I don't have any gains for the next 5 years, and then I finally have a gain in 2027, guess what? I'm going to have to pay tax on that gain in 2027. The loss from 2021 will have expired worthless. So capital gains and losses are really bad things for corporations. And if a corporation could structure its investments so as to give rise to only ordinary income and ordinary loss, that would be a good planning idea. And again, by the time we're finished with this course, we will come up with ways for corporations to do that if they so desire. Okay, what about dividend income? And I'll go into dividend income in a little more detail later on today. But for a non-corporate taxpayer, for individuals, the maximum rate of tax on dividend income is 20%. And again, for this class, I'm only using the maximum rates of tax because that's who your clients are going to be. And so there are lower rates of tax applicable to dividends, but let's stick with the maximum rate. The maximum rate of tax is 20%. But the stock has to be held for at least 61 days around the dividend day. And again, we'll go into reasons for that. And it's an anti-abuse section. It's an anti-abuse rule. Taxpayers were doing things that the government didn't like, and so they put in a holding period rule. If you're a corporation, instead of taxing your dividends at a different rate, what they say is you get a dividend received deduction of 50% of the amount of the dividend. So if you receive a dividend of $1,000, you know what, I'll just put it on the whiteboard, it's just easier. Okay, so if you're an individual, and you have $10,000 of dividend income, we do a special tax calculation. The $10,000 is actually pulled out of your income, out of your adjusted gross income when you're doing your tax calculation. So you don't subject to your normal tax rate. And instead you pay 20% tax rate. And you would pay $2,000 in tax. If you're a corporation and you have $10,000 of dividend income, when you're doing your tax return, you get a $5,000 deduction. It's a make-believe deduction. It's a dividend received deduction. And so what you end up with is $5,000 of taxable dividends. And the corporate tax rate is 21%. So 21% of $5,000 would be $1,050. And that comes out to a 10.5% effective tax rate on dividend income corporations. And in order for the corporation to have the dividends qualify for the dividend received deduction, there's going to be a 46-day holding period requirement. Right? And we'll talk more about that later on in the class today. Okay, so let's go back to the PowerPoint. We're still talking about investors. Now, investors can incur expenses. Let's assume that an investor borrows money to buy a security. They're going to end up having to pay interest expense. For a non-corporate investor, that interest expense is only deductible to the extent they have investment income. And for these purposes, investment income will be interest income and short-term capital gain. Dividend income, qualified dividend income, the income in which the taxpayer pays that 20% maximum rate of tax, that's not going to qualify as investment income, and long-term capital gains are not going to qualify as investment income. So they're only going to be able to deduct their interest expense to the extent they have short-term capital gains or interest income. If you're a corporation and you borrow money to buy investments, it's irrelevant. There's no limitation on their investment interest expense. Corporations have limitations on their interest expense in general, so it would fall under there, but there's no special rule with respect to investment interest expense for a corporation. Now, what if you pay someone to give you investment advice? So you're incurring investment expenses. If you're a non-corporate taxpayer, those expenses are non-deductible. If you're a corporation, they're fully deductible. And this is very important. So, and I want to bring this up and show an example as to why this is so important. So we talked about notional principal contracts. And right now, investors should not enter into notional principal contracts. So we have a notional principal contract. And we have a loss. If you're an investor, the loss is non-deductible. So if you can avoid it, you do not want to enter into a notional principal contract as an investor. If you're, and that again is for individuals. If you're a corporate investor, then the losses are deductible. All right, so investors should not be entering into notional principal contracts. They could end up with horrendous results, right? They can enter into two contracts. On contract one, They have a $50 million gain. Contract 2, they have a $50 million. Guess what? The loss is non-deductible, and they're going to have to pay taxes on 50 million of gains. The gains are going to be ordinary income, so they're going to pay tax at, roughly 39%. And they're not going to get the benefit of the loss. So economically, they broke even, and the next thing you know, they're going to be paying the government close to $20 million in taxes. That is not a good result. So investors do not enter into notional principal contracts. And I keep talking about a 20% rate of tax on long-term capital gains and dividends. And some of you are thinking to yourself, no, I've seen 23.8%. And you're right. The 23.8% as opposed to 20% is because there's a 3.8% tax that's imposed on investment income. It's a surcharge. It was to pay for the Obamacare changes to Medicare and to healthcare. And for our purposes, I want to disregard the 3.8% tax. So for our class, I still want to go with 20% is the maximum rate on capital gain, on long-term gains, 20% is the maximum rate on dividend income. And let's forget about the 3.8%. And the reason I'm going to do that is because a lot of the things that we're going to end up comparing in those classes, the difference between having a long-term gain and a short-term gain, and yes, short-term gains are also subject to the 3.8% tax. And you're going to pay your 39.6% maximum tax rate on your short-term capital gains. And so instead of making that 43.4 and long-term gain 23.8, let's just use 20% and 39.6%. Okay, and those are the basic rules with respect to investors. And again, I'm going to come back into some of these rules in a little more detail later on today. So the next person, and by the way, what are the characteristics of an investor? Probably the first thing I should have said. But an investor is someone who buys securities and holds them for a while. And the reason that they're buying or selling short securities is because they're looking to make money from the price movement over a long period of time. And they're also looking to get dividend income. If they're buying bonds, they're looking to earn interest income, but they're not looking to trade the stocks, on a daily basis. That's a trader. So a trader is someone who is constantly buying and selling stocks. They're not looking to hold a stock for a long period of time. They're looking to make money on daily changes in the price. So, a lot of the Robinhood traders might be traders for tax purposes. But their whole idea of a trader is to make profits from very quick movements in price. And when I say quick movements, I mean within a day or two. I'm not talking about a month or 2 months. All right, we're not looking for any long-term capital gains. And in order to be a trader for tax purposes, you have to do the trading by yourself. I can't hire someone else to do the trading for me. If I hire someone else to do the trading for me, then I am not a trader for tax purposes. And trading must be my primary activity. I can't be teaching at pace and then trading, even if I'm trading every day, but I'm not spending my full time trading. I'm really spending much more time being a professor. Trading must be your primary activity. Right? These are all the characteristics that you have to have in order to qualify as a trader for tax purposes. Now, if you're a trader for tax purposes, it doesn't matter whether you're a corporate or a non-corporate trader. The same tax rules apply. Your gains and losses are capital as a general rule. Now, if you make a Section 475 election and only traders can do that. What then happens is all your gains and losses are then treated as ordinary. They're not capital anymore. And at the end of the year, all your gains and losses are marked to the market. And what marked to the market means is that you recognize all your unrealized gains and losses. So again, let's just go to the whiteboard, give a simple example of that. Right, we buy securities. $1 million. And we haven't sold them during the year. We're still holding them at year end. And so at year end, securities are worth 300,000. If I'm an investor or a trader, right, as you can see, I'm not the greatest typer. For a trader with no 475 election, we have no gain or loss. Investors, traders who aren't using a mark-to-market system do not recognize gains and losses until they dispose of the security. If I'm a trader with a 475 election, I mark to the market. And what that means is I compare my cost, and we're going to learn that for tax purposes, that word is going to be basis. We compare our basis with amount realized. And on a mark-to-market basis, the amount realized is the fair market value of property at year end. So in this case, our basis was 1 million. Our amount realized is 300,000. And we have a loss for tax purposes of $700,000. And because we made a 475 election, it's an ordinary loss. That loss can be deducted against any other type of income. It is not a capital loss. So the benefit of the 475 election is that all your gains and losses are ordinary. Now, remember, if you're trading frequently, if you're trading on a daily basis, you're not going to have long-term capital gains anyway. So if you have capital gains, they're going to be short-term gains, and they're going to be taxed at the highest ordinary rate. And if you have losses and you're a trader and you don't make the 475 election, your losses are going to be capital, and you're not going to be able to deduct them because you don't have gains. So a lot of traders will make the 475 election because there really isn't a lot of downside to doing that, because they're not generating long-term capital gains. And again, as we go through other things in the course, we're going to find that if they make the 475 election, they're not subject to a lot of the rules that we're going to cover later on, like wash sales, straddle rules. There are a lot of things a lot of complications that go away if you make the 475 election and you are a trader. But I'm really getting ahead of myself now. So let's go back to the PowerPoint. Now, if you're an individual, so if you're a partnership and you want to elect trader status, I've never seen the IRS contest the partnership that has elected trader status. They might going forward, because you still have to show the requisite activity in order to be a trader. You really have to show that there's a lot of turnover, that you're not holding stocks for long periods of time, or bonds for a long period of time, and that you're actively trading the securities. Now, most partnerships have a whole business set up. They've got accounting people, they've got regulatory people, they've got traders, they're renting space. I mean, it really looks like a business, and they really should be treated as a trader, regardless of whether they have the requisite turnover, but that's not the state of the law. So we still need a lot of turnover in order to qualify as a trader. However, if you're an individual and you try to claim trader status, it is extremely difficult. So here are some representative cases. Stephen Paoli, he spent 4 hours a day trading, except that all his trades happened in 1 month. Why'd they happen in 1 month? Because he lost all his money, and he's had to stop trading when he lost all his money. So he wanted to be a trader so he could take his losses and claim them as ordinary and deduct them against his other income. And the IRS said, no, your losses are capital losses. You're not a trader. The case went to court, and the court found against Mr. Paoli. They said that his activities were not continuous, they weren't frequent, they weren't regular, and they weren't any of those things because he lost all his money. It's a very strange case. But again, it's indicative of how hard it is for individuals to win a case claiming that they're a trader. We have the state of Yeager. Yeager traded almost every day, except that most of his trades were purchases. And when he finally sold things and started selling things and then buying new securities, the things that he sold were held for over a year. Most of his gains were long-term capital gains. He was generating a fair amount of dividend income. And the court said, you know what, you're not a trader. You're not looking to make money from quick turnover. You're looking to make money from long-term appreciation. You don't meet the qualifications as a trader. And what Mr. Yeager was trying to do is deduct a lot of his business expenses as ordinary expenses, not as investment expenses. And the court said no. And his interest expense, he wanted to be claimed as business interest expense. And the court said no, where your interest expense is investment interest expense. And since most of your income is long-term gain, you can't deduct your interest expense. And then we have a really wild case, I think. Frederick Mayer. Mayer made more than 22,000 trades in a 3-year period. The problem is, yes, he was looking for capital appreciation, but the real big problem that we had was that he wasn't doing the trading. He hired people to do the trading on his behalf. And the court said, if you're not doing the trading on your own, you're not picking out the stocks yourself, you're not picking out the bonds yourself, you're not doing the trading yourself, then you're not a trader for tax purposes. And they found that Mr. Mayer was an investor. Again, remember, the people who are making the arguments that they're traders are trying to get ordinary deductions. They have losses typically. And that's why the IRS is contesting it. They're saying, no, you're not a trader. Your losses aren't ordinary. Your losses are capital, and you can't deduct them. Okay, if you do want to make the 475 election, how do you make it? And it's interesting, the way you make it is you attach a statement for the tax return for the year preceding the year the election is being made for. So if I want to make an election for 2021, it's too late. I can't do it because my tax return for 2020 was due April 15th of 2021. We're past April 15th of 2021. I can't make an election for 2021. If I want to, I can make an election for 2022, and I would make it when I file my 2021 tax return. And by the way, you don't count extensions. It's the original due date of the return. And again, keep in mind what the IRS and what Congress is concerned about. They're concerned about people making a trader election in year when they have a loss year. And so if I waited till now in 2021 and I see, through August, I just lost millions of dollars and there's no way I'm going to make it back in the last 4 months of the year, then I would love to make an election now. So what Congress is giving you is they're giving you 3.5 months. So up until April 15th of the year that you want to make the election, you can then make the election because you still have that much time to file your tax return. But they're only giving you a 3.5 month look back. They don't want you to cherry pick a year that you find, you have losses and now you want to get ordinary deductions for your losses. So you want to make the 475 election. All right, and remember, you must attach it to your tax return. There are a lot of people who don't make the 475 election correctly. Then when they go to have their tax return, like now, let's say for 2021, let's assume that I was trading every day and I lost $1 million. I go to my accountant next year to have my tax return done. And I say, I'd like that loss to be ordinary because I was trading every day. And I was doing it myself. I met all the requirements. The problem is I didn't make a proper 475 election. And the courts are very tough on this. If you don't follow the rules and you don't make the election properly, they're not going to allow you to make it. So if you're an individual and you've been paying taxes, your whole life, you must make it for really the following year. You make it with the tax return for the previous year. If this is your first year in existence, then obviously you can make it in that year. So if I formed an entity, if I formed a partnership to do my trading and I formed that partnership in 2021, there is no preceding year. So I could make my 475 election in the year that I was formed. That would be the exception. But if you don't make a valid 475 election, the IRS won't respect it. And for the most part, courts will not respect it as well. Okay, what if you're a hedger? And so who are hedgers? A hedger is someone who uses the financial instruments as part of mitigating against the risk in their business. So the best example of that are airlines. The one cost that airlines have that's a major cost and it's completely out of their control is the cost of oil. If their oil costs if the price of oil skyrockets, they're going to lose money because they can't just raise their fares because the price of oil is going up. And yes, if the price of oil goes way down, they'll make more money, but they're not worried about it. They're not looking for a windfall. What they're really afraid of is that they could go out of business or lose a lot of money if the price of oil goes up. So what they'll do is they'll buy futures contracts on oil. They'll buy oil in the market. And if the price of oil goes up, yes, they're going to lose money in their business, but they're going to make money on their financial bets on oil. And they're not doing it as an investor. They're doing it to hedge a risk in their business. And sometimes they'll enter into swaps, as we saw, where they really want to borrow at a fixed rate, but they go into the market to borrow at a floating rate, and they then enter into a swap to, in effect, convert their floating rate debt into a fixed rate debt. That's deemed to be hedging. And it doesn't matter if you were the one who was converting a fixed rate debt into a floating rate or a floating rate into a fixed rate. That's all deemed to be hedging. And hedging transactions give rise to ordinary income and loss. All gains and losses are treated as ordinary. Hedges are not marked to the market. You wait until your hedge is closed before you recognize the gains and losses, but all the gains and losses are ordinary. But you have to label your transaction as a hedging transaction, right? And it really has to be a hedge related to your business. So again, let me just quickly go to the whiteboard. Let's assume that I'm a gold miner. And I mine gold. And I anticipate getting 10,000 ounces out of the ground this year. And I know what my costs are to do that, what my mining costs are going to be. And let's assume that the price of gold is $1,200 an ounce. And again, in this course, I want to keep using American dollars, US dollars as my currency. So those 10,000 ounces are going to be worth $10,200,000 at today's prices. And I know, right, at today's prices. I know it's going to cost me $9.5 million to mine the gold. So I'd like to lock in my $700,000 of gain. So I enter into a contract sell 10,000 ounces of gold in 1 year for, I'm going to put down $10,200,000. In reality, it would be slightly more than that, because you'd also get paid interest on the money as well. But let's just use the $10,200,000. And then the price of gold fluctuates. And let's assume that it goes down to $9 million. I have $1,200,000 gain on my contract because I have a contract where I could sell it for $10.2 million. It's now worth $9 million. That's the future value. You know, I could sell my contract and have a $1,200,000 gain. And that gain is ordinary income, because that was a hedging transaction. That's not a capital gain. That wasn't an investment. Now, let's say that I'm mining gold and it's the same 10,000 ounces, but I enter into a contract to sell 50,000 ounces of gold in 1 year. 50,000 has no relationship to my business. 10,000 ounces would be deemed a hedge. The other 40,000 would be an investment. Right, so when you label something as a hedge, it has to be a real hedge. You can't be doing investing that has nothing to do with your business and try to get ordinary treatment on it, so have ordinary gain or loss. If you make money, it'll be a capital gain. If you lose money, it'll be a capital loss. Right? So it has to be a real hedge in order for it to be treated as a hedge of a transaction. But again, most businesses that are in the markets hedging are really hedging. They're not investing. And then finally, we come to dealers. Who are dealers? Those are people who make markets. Those are people who buy and sell securities because they're buying and selling to sell to customers or to buy from customers. So you have dealers and they buy and sell securities to the public on a regular basis. And the way they make money is they buy a stock at 100 and they sell it moments later at $100.02. And that 2-cent profit is how they make money. And again, let me just quickly go to the whiteboard. And again, if any of you buy or sell stocks online, what you'll see when you buy a stock, I want to buy Apple. All right, so the symbol for Apple is AAPL. And I want to buy it for $150 a share. Except when I go onto the screen, on my screen, my online screen, what I'm going to see is I'm not going to see $150 a share. What I'll see is $149.98, and I'll see $150.03. And what are those two prices? The dealer is saying, the dealer is willing to buy, or is willing to pay $149.98 if you want to sell. And the dealer is asking for $150.03 if you want to buy. Right, the $149.98 is called the bid, and the $150.03 is called the ask. So there's always this bid-ask spread, and that's the dealer. Joe's saying, anyone who wants to sell Apple to me, I'm willing to buy as many shares as, well, I'm willing to buy X number of shares at $149.98. And if you want to buy Apple, I'm willing to sell you X number of shares for $150.03. And the bid and ask is constantly changing. And if you want to buy for $150, you're really going to have to wait until the dealer says, okay, I'm willing to buy. I'm willing to reduce my ask to $150. Now they might say, all right, $149.98, for, you know, yes, I'll sell it to you for $150. But if it's really $149.98, $150.03, you're not going to be able to buy it at $150. You're going to have to pay $150.03. That 5-cent spread is how the dealer is making their money. And the 5 cents adds up when you start multiplying that by millions and millions of shares. So that's how dealers make money. They have no view on whether they think Apple's going up. They have no view whether Apple's going down. All they know is that they're willing to buy at $149.98 and they're willing to sell at $150.03. And every time they can buy and sell one share, they're going to make a nickel. And that's how they're going to keep making money. Right, so stock to a dealer is their inventory. How are dealers taxed? All gains and losses are ordinary. There is no capital gain or loss. All of the securities are marked to the market at the end of the year. So like we talked about traders who make the 475 election, that's dealers. They just pay tax on all their unrealized gains and losses. And swaps are also deemed to be inventory, which we could spend hours on talking about how we should mark to market swaps, and are swaps really inventory? But the answer for tax purposes is yes. And basically, however you mark them to market for financial statement purposes is how you would mark them to market for tax purposes. But just remember that dealers do not use normal inventory methodologies. They must use mark to market. And they're going to pay taxes on all their unrecognized gains and losses at the end of the year. And everything is ordinary for a dealer. Just to give you some history, prior to market, dealers really abused the system. They were using lower of cost or market. And so if the market went down, they took the loss. If the market went up, they used cost and they didn't recognize the gain. An old dealer, and this dealer hasn't been in existence for a long time, Drexel Burnham Lambert, used last in, first out for treasury bills, which was really abusive because treasury bills are debt issued at a discount and they only go up in value. As the time passes by and they get closer to maturity, they get closer to par and they're issued at a discount. They were able to create losses at will. And they basically determined how much tax they wanted to pay at the end of the year by changing the levels of their inventory. So what Congress found, and is what I was saying in last week, or in the first class, is that the general tax rules just don't apply to securities. They don't work well. And inventory methodologies is one of them. And so the one that Congress feels works the best, and I think makes a lot of sense, is to use mark to market for securities dealers. We do not use normal inventory methodologies. Okay, so those are the basic rules, again, with respect to investors, traders, hedgers, and dealers. Unless I specifically say so, I'm not going to be dealing with 475 traders. I'm not going to be dealing with hedgers, and I'm not going to be dealing with dealers. The only class of people or entities dealing in securities that we're going to cover in this course are investors. Okay, so the first thing that we're going to do is determine, when we sell a security, do we have a gain or loss? And the code section is 1001. 1001 tells us that the gain equals the excess of the amount realized over the adjusted basis. So we always have to know, what is our amount realized? What is our adjusted basis? Once we determine that, we then know whether we have a gain or a loss. The entire amount of the gain that's realized will always be recognized. For our purposes, that's going to be 98% of the time. Whenever we realize a gain, whenever we have a disposition of a security and we have a gain, we're going to recognize it. And by the way, what's the amount realized? The amount realized equals cash plus the fair market value of property received. So I just want to do this quickly. 98% of the time, the amount realized is going to be cash. But just remember that if you receive property, the fair market value of the property is deemed to be an amount realized. And the one thing that, again, I want to point out, so I've got 100 shares of Apple that I acquired for $40,000. And the fair market value today is $100,000. And I want to trade it for shares of Microsoft. And what am I going to trade it for? Obviously, if I'm giving up $100,000 of Apple, I'm going to receive $100,000 of Microsoft. Now, it looks like I'm trading something worth 100,000. I'm receiving something worth 100,000. So your initial reaction might be that there's no gain or loss on this transaction, but that's not how taxes work. What taxes say is, what's your adjusted basis? My adjusted basis in the shares is $40,000. What's my amount realized? The amount realized is the fair market value of what I'm receiving. And so I'd have a gain of $60,000. All right, so you don't compare fair market value to fair market value, or you would never recognize gains and losses, because all of our trades are done at equal value. What you always compare is your adjusted basis with the fair market value of what you've given up. Because the person who gave up their Microsoft, they could have had an adjusted basis of 150,000, and the fair market value of their Microsoft is 100,000. They're going to receive 100,000 of my Apple, so their adjusted basis is 150,000. Their amount realized is 100,000, and they have a loss of 50,000. So again, they gave up 100,000. They received 100,000 worth of property. I gave up 100,000. I received 100,000 worth of property. I have a $60,000 gain. They have a $50,000 loss. And that's because you always compare your adjusted basis against your amount realized. Okay, what's the basis of property? 90% of the time, the basis of property equals its cost. What are some exceptions to that? When you receive property from someone who's died, right? You're getting property from a decedent. Someone passes away, they leave you property in their will. The basis of the property that you get is equal to the fair market value on the date of the person's death. All right, it's commonly referred to as a step up in basis because property typically goes up in value. So if the person who died bought the property for $30,000 and it's worth $100,000 when they die, and you inherit the property, your basis will be $100,000. Now, likewise, they could have bought something for $130,000. It could be worth $80,000 when they die. Your basis would be $80,000. That would be a step down in basis. But the rule is whatever the value of the property is on the date of death, that becomes the basis of the property of the person who inherits it. And whether estate tax is paid or not is totally irrelevant. So we don't care about that. All right. Now, that's when you receive property from someone who died. What if you receive property from someone who's alive? You receive a gift. The general rule is that whatever the basis was in the hands of the donor, that becomes your basis. So when someone gives you a gift, you're going to ask a few questions. You're going to ask, what was your basis in the property? Because as a general rule, that's going to become your basis in the property. Then you'll ask the person, by the way, what's the fair market value of this property today? Now, if it's publicly traded, you don't have to ask that question. You'll know the question. You'll know the answer. You could look it up. The reason that you're asking this question is because if the fair market value of the property has gone down, we end up with a different basis rule. And I'll go over some examples. And if the property has gone down in value from the time that the donor gave you the property, you're not going to know your basis until you dispose of the property. Okay, now if the property has gone up in value, you're going to take over the donor's basis, plus you're going to increase the basis for part of the gift tax that the donor pays when they give you the property. So remember, when a gift is made, the recipient of the gift doesn't pay tax. The person making the gift pays the tax. And what we do is, let me go to the whiteboard. And the rule is, I don't know what I just pressed. Okay. So for gifts of appreciated property, we start with the donor's basis. And then we add a portion of the gift tax attributable to the increase in value. Okay, so donor's basis is 100,000. Fair market value at date of gift is 500,000, and the donor paid $50,000 in gift taxes. Well, of the $50,000 in gift taxes, 400, they paid gift tax on 500,000. Because that was the fair market value of the property on the date of the gift. The appreciation was 400,000. So 400,000 divided by 500,000 times the gift tax paid equals $40,000. $40,000 of the gift tax was attributable to the appreciation. So your basis starts off as the donor's basis. And we add to that attributable to the appreciation, and that's 40,000. And our basis is $140,000. And that's the basis for both gains and losses. Right? With depreciated property, we have a completely different set of rules. Right? Donor's basis was $300,000. Fair market value at gift is $200,000. So the first thing is we don't care about gift tax, right? Because the property didn't go up. So since the property didn't go up in value, whether they paid gift tax or not is irrelevant, because we only would add to our basis the amount of the gift tax attributable to the appreciation. So we don't care about gift tax. And now the rule is we wait until sale. If sold at a gain, use donor's basis. If sold at a loss, use fair market value on date of gift. So we don't know our basis until we sell. So if we sell for 75,000, then our basis is 200,000. And we have a loss of $125,000. If we sell for $350,000, then our basis is the donor's basis. And we have a gain of $50,000. Now the question is, what happens if we sell for a price in between the donor's basis and the fair market value? So if we sell for $225,000, if we use the fair market value, we would have a $25,000 gain. Well, we're not supposed to use the fair market value unless we have a loss. So we can't use that. And if we use the donor's basis, we would have a $75,000 loss. But we're only supposed to use the donor's basis if we have a gain. So we can't use either. So the answer is no gain or loss. And when you report this on your tax return, whatever you sold it for, that's what I would show as the basis. There's no other way to show that on a tax return. All right. So when you sell property that has gone down in value, when you receive property that has gone down in value, you won't know your basis until you sell the property. And then we apply these rules. When you receive property that has gone up in value, you'll know your basis immediately. You take the donor's basis, ask the donor if they paid any gift tax, take the portion of the gift tax attributable to the appreciation while they held the property, and that will go into your basis. All right. So the basis for property received by a gift gets a little complicated. Okay, where are there other problems with basis? you have multiple lots of the same security. So again, I just think it's easier to do this with the whiteboard and show examples rather than just give you rules. If you don't like this, let me know. Send me a message saying you don't like me going to the whiteboard and I'll stop doing it. But I really think that's the only way to really learn this stuff. And if you like it, let me know also. All right, so we have multiple lots of same security. So buy 100 shares. And this is all, again, all Apple. At 100 equals 10,000. Then I buy another 100 shares. But this time I pay $120 a share and I spend $12,000. And then finally, I buy 100 shares at $140 a share. That equals $14,000. And when everything is all said and done, I own 300 shares and I've spent $36,000. Now, an economist would tell you your basis should really be $120 a share. This is all fungible property. And who cares that you paid 100 for the first 100 shares, 140 for the last 100 shares, and 120 for the middle shares. Except for tax purposes, we care. We treat each lot independently. And I hope I spelled independently. So I now sell 100 shares at $120. So I sell it for $12,000. If I sell the first lot, I have a $2,000 gain. Sell second lot. Equals 0, gain or loss. If I sell the third lot, equals a $2,000 loss. Now, an economist will tell you this is crazy. But for tax purposes, this is what we do. Now, what's nice is this gives you tax planning opportunities. You can, if you make no identification, the default rule is FIFO. That's the default. And what does FIFO stand for? First in, first out. So if you make no identification, you're going to have a $2,000 gain. If you want to, you can make a specific identification. You can tell your broker which shares you want to sell. And so if you tell your broker, sell the shares that I bought at $120 a share, I would have 0 gain. If I told the broker, sell the shares that I bought at $140 a share, I would have a $2,000 loss. Now you can make the specific identification on a trade-by-trade basis. Or you can give your broker blanket instructions. right? And so you might always tell your broker, sell my highest shares, sell highest cost shares. Because remember, for tax purposes, we want to minimize the amount of income. Economically, we bought 300 shares for $36,000. We sold 100 shares for $12,000. That's what's happened economically. Now, for tax purposes, we get to choose. Do we want to recognize $2,000 of gain and pay tax on that? Do we want to have a transaction that has no gain or loss? Don't pay any tax. Or do we want to have a transaction that actually produces a $2,000 tax loss and might give us a benefit? Now, if we're a corporate taxpayer who has no other capital gains, and they typically don't have capital gains, they may not want to generate a loss because that loss may never serve them any purpose and it might expire worthless after 5 years. But if you're an individual, take the loss. What do you have to lose? If you don't have gains, you just carry forward indefinitely. And if you have gains, you can deduct it. You can deduct the loss against those gains. So this is where you want to do tax planning. You want to make sure if you have multiple lots that you make identifications. Now, if you buy, let's assume that we bought the first 2 lots at Goldman Sachs. That's our broker. And we bought the last lot at Morgan Stanley. And then we sell the shares at Morgan Stanley. We've made an identification. We have a de facto identification. We can't sell the shares bought at Goldman at Morgan Stanley. All right, so these rules apply based on the shares in your account that you're selling out of. So if we sold 100 shares at Goldman and we didn't make an identification, we would end up with FIFO, and we would have deemed to have been sold the $10,000 shares. If we do it at Morgan Stanley, the only shares we have at Morgan Stanley are the shares we bought for $14,000. Those are the shares that we sold. All right, so that's what happens when we have multiple lots of the same security, how we determine our basis. All right, mutual funds. Mutual funds is the exception to the rule. You're allowed to use average basis when you buy a mutual fund. Okay, so we've talked about basis. Now, the next important thing that we have to talk about is holding period. Why do we care about holding period? Because we get different rates of tax for long-term capital gains. What's a long-term capital gain? A long-term capital gain or a long-term capital loss, the holding period is more than 1 year. And let me just go through this. What happens when an investor gives an order to buy stock? What is actually occurring from a legal standpoint? When you give an order to buy stock, I tell my broker, I want to buy 100 shares of Apple and I want to pay $150 per share. You're telling the broker, this is the number of shares that I'm going to buy, 100 shares. This is the price that I'm going to pay, $150 a share. And by the way, I'm giving you the order today. So we're trading it today, but I'm not going to give you the money until 2 business days from now. And you're not going to give me the shares, and I'm not going to become the legal owner until 2 business days from now. If this were any other property except for stock, my holding period would start when I became the legal owner, and that would be 2 business days from now. For stock, though, that's not what happens. The holding period begins on the date after trade day. And the holding period ends on the trade date of the sale. And if you think about it, that's so that we end up with the result that most people think is the right result. If I just asked you a question, if I just said, hey, I bought stock today, well, I'm not sure what day you're going to be looking at this. But if I bought stock on September 1st, 2021, what would be a year and a day? And most people would say September 2nd, 2022. Now that's the answer for tax purposes. The problem is, technically a year is January 1st to December 31st. So a year and a day from January 1st, let's say 2021, is really to January 1st, 2022 is really 1 year and a day. So the tax rule says, we don't want to come up with that. We want the normal answer. The normal answer is September 1st to September 2nd. So what they say is, if you buy stock on September 1st, your holding period starts. September 1st is the trade date. September 2nd is when your holding period actually starts. Right, and that way, when you sell it on September 2nd of the following year, you have a 1 year and 1 day holding period. Also, be very careful. We go by dates. We don't count days. We don't say 365 days is a year, right? Because if you have a leap year, you're going to mess things up. And that happened to me at Citibank. We had someone, and I couldn't understand it, but they had the trade date was (1/15/2020) for the purchase, and the sell was 1/15/2021. And why did they do this? Because they had a large gain, and they came up a day short from long-term gain treatment. And I saw this though a few days before 1/15/2021. I saw it a few days before the trade was going to come off. And I'm going, what is going on here? And the reason that this happened is this was a contract, and it was written by a computer person, and what they did is the sell date equals trade date plus 366 days. The problem is 2020 was a leap year. Right? So you don't fall into this trap. You don't count days. You go by dates. And what we ended up doing was we amended the contract to change sale date to 1/16. And we told the client if the IRS ever checked this and audited them and they ended up having to pay short-term gains rates, we would pay them their difference in tax. But let's try this and see if that works. All right, so remember that it's got to be 1 year and a day based on calendar days. Don't count 366 days. What's the holding period for stocks acquired by a gift? If you sold for a gain, so you're using the donor's basis, you count the holding period from the donor. If you sold it for a loss, so you're using the fair market value as your basis, there's no tacking. If you acquire stock by inheritance, they end up with a funny rule. Your holding period starts on the day that you acquired the property. But if you sell it for a gain or a loss, it's deemed to be long-term. So if you sell it within a year, even though you have less than a 1 year holding period, it's deemed to be long-term gain or loss. And that's code section 1223.9. So we end up with a funny rule with respect to determine how you determine long-term gain or loss when you acquire property by inheritance. Again, remember with property acquired by a gift, if you use the donor's basis, you tack on the donor's holding period. If you sell it for a loss, you don't tack on the holding period, which is a very pro-taxpayer rule. Because remember, long-term gains are taxed at a lower rate. Short-term losses go against short-term gains. And so you want your losses to be short-term if you have a choice. All right, and finally, I want to talk about dividend income. First of all, should dividend income be taxed at all? And in basically every country in the world except the United States, dividend income is not taxed. All right, and so why is that? Again, let's go to the whiteboard. Let's erase all this. I own stock. And it's worth 100,000. I receive a dividend, 10,000. All of the things being equal, the stock is going to go down in value by the amount of the dividend. They've just given away that amount of cash. So the stock will be worth $90,000. So before I received the dividend, I had $100,000 of wealth. After I received the dividend, I still have $100,000 of wealth. I really haven't received anything. All right. So that's why most countries do not impose a tax on the recipient of dividend income. In the United States, we do. And as we said, for an individual, you pay a 20% rate of tax. So that's a good rate of tax. For a corporation, we get a 50% dividend received deduction. Now we have holding period requirements. Why do we have a holding period requirement? That has nothing to do with this logic. The logic is I have the same value afterwards as I had before. I really shouldn't pay tax to begin with. And the government says, you're right, but we're charging you tax anyway, but we'll give you this benefit. But in order to get this, we have to have a holding period. So let's do the corporate one first, and the same logic applies to the individual. So the government, so what would happen is, let's assume that I had $10,000 of capital gains from other transactions. And I have this, so I say, hey, there's a stock worth $100,000. And I see that it's going to pay a 10% dividend. So I buy the stock. I pay $100,000. I get the dividend and the stock goes down by 10,000. It goes down to 90,000. So I sell stock for $90,000. And I end up with a capital loss of $10,000. But at the same time, I have dividend income of $10,000. Now, before the transaction, I have 10,000 of capital gain. And I pay tax of $2,100. After the transaction, I have zero capital gain because the capital gain and capital loss wipe each other out. So I have zero capital gain. I have $10,000 of dividend income. I get the $5,000 dividend received deduction, and all I pay is $1,050 in tax. So the government says, you know what, you want to play that game, we'll let you play that game, but you can't buy and sell the stock overnight. You're going to have to take risk. And the way they make you take risk is you have to hold the stock for at least 46 days. And now some of you will remember from last class about the economics of options, right? So I say, okay, government, you want me to hold the stock for 46 days? I'm going to buy the stock for $100,000. And I'm going to buy a put with a $100,000 strike price for, let's say, $500. And the put will have 46 days to maturity. Well, if I do that and the stock goes down to 40,000, 30,000, I don't care where it goes to, I could exercise my put and I could sell it for $100,000. So it's going to cost me $500 to ensure no loss. And I saved $1,050 in taxes. And remember, if I buy a put, I get to keep all the upside. If the price of the stock goes up, I just let the put expire and I'll actually make money with the stock going up. I'll actually end up with a windfall. So the government says, you know, we know all about puts and options. So you can't, so in determining the 46-day holding period, don't count any day in which you own a put. And then we talked about writing calls. And they also said, don't count any days in which you wrote a call if the strike price of the call is less than fair market value, right? Because they're saying you're giving yourself too much protection. So they know about options. This is why I talked about, and why I said that learning about the economics of options is so important. It's not the taxation of options, it's how can options be used in other areas of the law, and this is one of them. So in determining your 46-day holding period, and the same for individuals to 61 days, do not count any period in which you own the stock, and don't count any period in which you write a call. Also, in determining the holding period, there's a certain amount of days that you have to count. So for the 46-day holding period, there's something called an ex-dividend date. And what is the next dividend date? So there's a record date, an ex-dividend date, and a payable date for all dividends. So the record date is whoever is a shareholder of record receives the dividend. The payable date is the date the company pays the dividend. The ex-dividend date is a function of the stock market. So if you remember, it takes 2 days for a trade to settle. So if the record date is 9/2/2021, the ex-dividend date will be 9/1. It'll always be the day before the dividend. And what that means is, starting on 9/1, anyone who buys that stock, they're not going to get the dividend. So that's the ex-dividend date, because if I buy the stock on 9/1, I'm not going to get the stock until 9/3. I'm not going to be a record holder until 9/3. So in measuring the holding period, you have to obtain 46-day holding period during the time beginning 46 days prior to the ex-dividend date and ending 46 days after the ex-dividend date. And that's the time period that you use to count the days. So if the ex-dividend date is, let's say, 9/1/2021, you have to get your 46-day holding period during the time span that begins 46 days before. So there are 31 days in August, and then we get 15 days in July. So that would be July 17th. When you count days, if you subtract the last day from the day that you begin your count, add 1 to that. So if you go 17, 18, 19, 20, 21, 22, 23, 24, 25, 26, 27, 28, 29, 30, 31. Count on your fingers. That'll be 46 days before. And it ends 46 days after September 1st. So that's 29 days in September. We don't count September 1st. And we end up with 17 days in October. So it ends on October 17th. So between July 17th and October 17th is the period in which to obtain the 46-day holding period. And the same rules would apply to individuals who have to get a 61-day holding period, and you just insert 61 into the rules wherever I put in 46. So here's a chart of that. There's an extraordinary rule. If there's a dividend of 10% or more, the government says, you know what, that's just too abusive. We don't think 46 days is enough. And so the rule is you actually have to hold it for 2 years prior to the announcement of the dividend. Once they announce the dividend and it's more than 10%, we don't want people buying the stock for tax purposes. So if you've held the stock for more than 2 years prior to the date of the dividend, then you can get the dividend received deduction. Otherwise, we're not giving you the benefits of the dividend received deduction. I'm not going to go into the Seagram's DuPont transaction. It really was a fascinating transaction. If you Google it and you Google my name, there'll be an article in the New York Times that comes up talking about this transaction. And by the way, they saved over $2 billion in taxes. So there was a lot of value into this transaction. All right, and then finally, the two final things that I want to talk to about are mutual funds. Mutual funds, when they pay dividends, they actually pass through the nature of their dividends for long-term capital gains. So, and remember, mutual funds are entities that are buying and selling securities, and individuals are buying mutual funds because they otherwise wouldn't be able to hold all of the securities that the mutual fund is able to buy. So when you buy a mutual fund, the dividend of mutual fund is treated as long-term gain to the extent the mutual fund had long-term gains that made up that dividend. So I buy a fund for $100,000 and I receive a long-term capital gain dividend and I receive $5,000. I then sell the fund the next day and I'm going to end up with a $5,000 loss. If there were no special rules, my loss would be short-term and my gain would be long-term. And you might say, who cares? Well, if I have other capital gains not related to this transaction, and they were short-term gains, so I have 5,000 of short-term gains from other transactions, I could now take my $5,000 loss and they would offset and I would have zero short-term gain and I would be left with $5,000 of long-term gain. Instead of paying tax I would pay 20%, right? So the government said, that's no good. And so the rule that they came out with is if you receive a long-term gain dividend and sell the shares within 6 months, the loss up to the dividend is treated as long-term, right? And that takes away the benefit. Because now, to the extent that I have a long-term gain dividend, I sell the mutual fund at a loss. Any loss that I have up to the amount of that dividend becomes long-term, and I don't get that conversion. Right? So the government is aware that people are doing that. Why they did 6 months is because back when they made up that law, the holding period to have long-term gains was 6 months. They really should change it to 12 months. So if someone wanted to, if the dividend was large enough, they could buy the mutual fund, receive the long-term gain dividend, hold it for 6 months and a day, sell it, and end up with a short-term loss. So you could still do it, but now you're taking risk for 6 months of the day, and the dividend would have to be tremendous in order for someone to be willing to take that risk with respect to the mutual fund and hold it for 6 months. Right? Whenever you see some holding period rule, and it makes no sense, it has nothing to do with basic economics or basic concepts, it's because of an abuse that Congress is trying to deal with. Okay, and then finally, when you receive dividend income from a corporation, for those of you who've taken international taxation, it's important to know whether your dividend is foreign source income or whether it's domestic source income. And if you have capital gains and losses, it's the same thing. You want to know whether it's domestic source or foreign source, because in taking foreign tax credits, you can only take foreign tax credits to the extent that you have enough foreign source income. And again, and all of you who've taken me from tax 627, one of the cases that we did in 627 was the Compact case. And what happened in Compact was Compact bought shares of Royal Dutch Petroleum. They were a foreign company, obviously. When Compact received the dividend, that was foreign source income. When Compact sold the stock, it was a capital loss. And the way the rules worked was that the capital loss was domestic. So we ended up with a transaction where the income was foreign source, the loss was domestic source, and we were getting foreign taxes withheld, and we wanted to get a foreign tax credit. And because of the mismatching on the sourcing of the income, Compact was able to do that, and Compact was able to win their case. So there are a few slides on Compact. I'm not going to go over it again. We went over it in 627. Take another look at the Compact case if you're interested. But this is where a knowledge of the market. So we understood what was happening, that we weren't taking a lot of economic risk. We knew we were having dividend income. We knew we were going to end up with a loss. We were going to sell the stock shortly after receiving the dividend income. There was a mispricing in the marketplace on the amount of the dividend income, the amount of the loss that Compact incurred. And then combining that with our tax knowledge of the foreign tax credit, and that we had a mismatch here where the dividend income was being taxed as foreign source income and the loss was being taxed as a domestic source loss. Putting all of those things together gave Compact a great tax result. So if you go back and look at the Seagram's transaction, that was taking knowledge of options, knowledge of corporate law, corporate tax law, putting that all together, and you come up with a transaction where Seagram's literally saves billions of dollars in taxes. And then we have the Compact case where because of a mismatch of the sourcing of income and knowing about securities, we're able to combine that and end up with a very pro-taxpayer transaction. All right, and we talked about losses, capital losses are non-deductible against other income. They can only be deducted against capital gains. For individuals, you carry them forward forever. For corporations, you can carry them back for 3 years, carry them forward for 5 years, and then they're lost forever. All right, and we talked about investment expenses. They're deductible for corporations, they're non-deductible for individuals. And again, the big one, the real killer would be losses on swaps. Those are not deductible. For investors, for individuals, individuals should not be entering into swaps. And partnerships that are traders that are not, the partnerships that are investors, they're not traders. If you have a partnership that's trading securities and they're an investor, they're not a trader, they should not be doing swaps. All right, so let's end on that note. Again, there's a homework assignment, do the homework. I'll respond to the homework and give you feedback. And the homeworks will deal with problems going over the concepts that we dealt with in this class. All right, so we'll see you all in our next class.